Question 1. Why do interest rates create so much fear for homebuyers?
Because interest rates are emotional. Buyers hear a number 6%, 7%, 8%, and immediately compare it to what they wish they had gotten years ago. But comparison is dangerous. I'm Duane Buziak, and what I see every day is buyers freezing. Not because rates are bad, but because they don't understand how rates actually work, or how to use them strategically. Fear comes from confusion. Confidence comes from clarity.
Question 2. What exactly is a mortgage interest rate?
At its core, an interest rate is simply the cost of borrowing money. It's not a punishment. It's not a reflection of your worth as a buyer. It's a market-based price for capital. Your interest rate determines how much interest you pay each month. How much of your payment goes toward principal, your total cost over time. But here's what most buyers miss. The rate is only one part of the payment equation.
Question 3. What factors actually determine your interest rate?
Many buyers assume rates are the same for everyone. They're not. Your rate is influenced by credit score, loan type, FHA, conventional, VA, etc., down payment loan term, market conditions, property type, debt-to-income ratio. Two buyers can apply on the same day and receive very different rates. That's why personalized strategy matters.
Question 4. Why do rates change so often?
Mortgage rates move based on inflation trends, economic data, bond markets, Federal Reserve policy. Indirectly, rates can change daily and sometimes multiple times a day. But here's the important part. Short-term movement should not dictate long-term decisions.
Question 5. Why comparing today's rates to past years is misleading?
Buyers often say, "My friend got 3%. My parents had a 4% loan. I missed the best time." But those comparisons ignore reality. Home prices were lower then, but competition was brutal. Inventory was tighter, and many buyers couldn't even win a home. Every market has trade-offs. As Duane Buziak, I remind buyers, you don't buy a rate, you buy a home strategy.
Question 6. How do interest rates affect monthly payment? Really?
Rates impact payment, but not always the way buyers expect. For example, a small rate change might equal $100 to $200 per month. That same buyer might save more through seller concessions or buy-downs. Focusing only on rate can cause buyers to miss bigger opportunities. This strategy is misunderstood but powerful. It means buy when the home fits your life and budget. Lock in the house, improve or adjust the rate later if markets change. Rates are temporary. Homes and equity are long-term. Historically, rates rise and fall. Refinancing exists for a reason. Question 8. Is refinancing guaranteed in the future? No, and that's an important truth. You should never buy a home assuming refinancing will happen. But you can buy a home knowing refinancing is an option. History shows rate cycles repeat. Prepared buyers benefit the most. Smart buyers plan with flexibility, not assumptions. Rate buy-downs allow buyers to reduce their interest rate temporarily or permanently lower monthly payments. Early on, often funded by seller's builder. Incentives, negotiated credits. In today's market, this is one of the most underused tools because sellers care about closing the deal. Net proceeds, certainty. Lowering a buyer's rate can make payments affordable, increase approval strength, help deals close faster. This is why negotiation strategy matters as much as the rate itself.
Question 11. Fixed versus adjustable rates. How should buyers think about this?
Fixed rate loans, predictability, stability, long-term planning, adjustable rate mortgages, ARMs. Lower initial rates, strategic for short-term ownership. Useful in specific scenarios, neither is good or bad. They're tools when used correctly. Waiting for the perfect rate often leads to higher home prices, more competition, fewer concessions. Markets don't pause for individual buyers. The best time to buy is when your finances are ready, the payment is comfortable, the strategy makes sense. A lower price with a higher rate can cost more monthly than a higher price with a lower rate. That's why monthly payment, not purchase price, should guide decisions. Payment determines lifestyle. Lifestyle determines satisfaction. Online rates often assume perfect credit. Exclude real fees, ignore personal factors. They're estimates, not offers. This leads buyers to unrealistic expectations and frustration. Even small credit improvements can lower rates, reduce mortgage insurance, increase loan options. Sometimes a 30 to 60-day strategy can change everything. That's why early planning matters. Common mistakes: waiting too long, ignoring payment comfort, chasing the lowest rate instead of best strategy, locking emotionally instead of logically. Rates require calm thinking, not panic.
Final question: what's the most important thing buyers should remember about interest rates?
Interest rates should never stop you from building stability. They are temporary. Your decisions should be strategic, and your confidence should be grounded in understanding, not fear. If you want a personalized rate strategy that fits your goals, not headlines, I'm here to help. 804-212-8663, Duane at Coast2. CoastML.com.